Hi, I'm Martin Conlon, Head of Equities at Schroders. I'm going to spend the next 5 or 10 minutes giving you an update on what's happened in the last 12 months in markets, what we're doing with portfolios and how we're seeing the upcoming 12 months. If I start with the conditions in the last 12 months, there are probably plenty of things that have surprised us, but this slide really just encapsulates how much emotion has driven investment returns in the past 12 months. What you can see here is that the earnings changes across most of the sectors in the domestic market have really not seen a lot of change in the last year. So what has driven returns is emotions of investors changing and the re-rating or changes of multiples that you've seen across the range of sectors in the ASX. The charts there show you why the size of the green bars, which of those sectors have really seen the most re-rating. Probably the one that surprised us most has been financials, where banks, being a massive proportion of the market in Australia, has seen a huge re-rating and have driven a lot of the return. Some of the others, less surprising if you like, in that IT really chasing a lot of those US themes, but the other side of the equation is really about the propensity of the market to really just want to play for growth. So things like energy and materials on the other side, exposures to China. You've seen that most of the world really doesn't have much interest in what's going on in Europe. There's a lot of pessimism around China, a lot of pessimism on Europe. The US remains the epicenter of the world, and returns really are reflecting that. If I dissect that down to what's happened in terms of the drivers of index returns here, you can see on this chart just how much of the return has been driven by financials. So when you look at that overall market return, banks, most of it, that has been the $64 question for fund managers in the past year. If you've had banks, you've done okay. If you haven't, you haven't. Few other stock specifics contributing to that, but that's been the major driver. When it comes to our portfolio performance, obviously it's been a disappointing year. You can see there the contributions to active return. A lot of the pain has been done by that underweight positioning in banks, so CBA and Macquarie costing a lot of money relative to the index. Most of the rest of it obviously has been a lack of exposure to those sectors where euphoria has really seen a lot of multiple expansion. So the Goodman Groups, the WiseTech Globals, the Aristocrat, a lot of those have seen exceptional market gains, 50, 60, 70% plus, on the back of pretty minimal changes in earnings. On the positive side, stock selection for us in resources was very good and offset a lot of that pain. So while the material sector wasn't great, our stock selection within that did rescue a lot. So underweight iron ore, some good exposures to stocks like alumina, which then became Alcoa. Some of those things have helped the portfolio over the past 12 months. If we look at performance in a longer term perspective, obviously the real damage has been that the poor performance in the shorter term has damaged, as it always does, the long-term numbers, such that the active returns are really not what we'd like over the longer term, but we do, and I'll go on to describe why. I think the market's at very interesting junctures in terms of the extremes that we're at, and I think people do really need to consider that in looking forward when you're trying to work out, well, is it sensible to extrapolate what's been going on in the past 12 months and expect the same thing to happen? Or are the risks really stacked towards the fact that something's got to change? And we firmly sit in the latter category. If I change tack and look forward to what's happening, the reason I make those comments about the market being in an interesting juncture is that growth at any price, if you like, has really been the dominant driver of markets over what has been most of the last decade now. You can see that chart on the left, the green bar being the growth index really has just shot the lights out. Our performance has correlated pretty closely with that. So that period where there was reversion in 2021, 22, performance was much stronger. You've seen off to the races again in the last 12 months where the market's narrowed, small number of stocks contributing all of the returns, as we touched on earlier. The same thing's true of the US. So that breadth is really narrowing. It's not a broad cross-section of markets which are driving investors' returns. It's whether you have that small number of winners. In digging down into why we think it's going to be hard to replicate a lot of those returns, tech in particular, the multiples that we're seeing across that, and it's both in the US, or less so in the US really, because some of that Magnificent Seven really has had strong earnings. But in Australia, it's all about multiples. So you can see on the left there a number of the higher profile Australian tech stocks. And the one thing that's there is you'd say there's not a lot of revenue and earnings supporting enormous amounts of market capitalisation now. So you can see there's something like $150 billion of market value with only $2 billion of operating profit. That is effectively extrapolating an enormous amount of future growth and then a stabilisation at that level and maintaining it forever in order to just justify current valuations. It is clearly not normal in historic circumstances to see multiples anything like what we're seeing in the tech sector at the moment. Multiples of 50, 100, 200, 300. The amount of growth that they're pricing into the distant future is crazy. And if you look at the market cap growth chart on the right there, the amounts of market capitalisation that are being added for very small earnings changes and quite small revenue numbers is pretty astonishing. So WiseTech there, $20 billion of market cap added in the last 12 months. That is a large industrial company. WiseTech's now about the same size as Woolworths, $40 billion company. The only difference is that Woolworths makes more than $3 billion of EBIT and WiseTech has $1 billion of revenue. The gaps are cavernous, and we think that the odds of tech being able to keep on delivering that performance given the starting point is just low. The other big thing that I think we caution investors on at the moment is as more and more of the world's money piles into the US, you've got to be careful not to give away your diversification at the wrong time. So that chart on the left is just showing you how much of the world's market cap is in the US, and it's something like 70% of the world's equity capitalisation now. It's scary when you think in the context of that means earning 70% of the profits in the world in the long run. And on the right, an increasingly small number of companies are contributing that market value. So the market's narrowing, it's getting more and more of the money in the US. We'd look at it and say the sensible way to diversify in that context is to try and make sure you've got a reasonable amount of money outside of the US and outside of those thematics that are driving what we think are pretty crazy market conditions at the present. So what are we doing at a portfolio level? Well, going back to that slide at the opening where we saw those market re-ratings and de-ratings on the back of very little earnings change, where there hasn't been much earnings change and there's not much change in our view on the prospects for the future, yet there's a lot of market value change. We're trying to stand against those. So you can see in this heat map, we're moving against things like consumer discretionary and banks that have done really well. We're moving into things like materials and healthcare that have really not been caught up in the same wave. That US exposure that I talked about, you really need to be careful to make sure as the market chases the US, interestingly in Australia, they are chasing the stocks with exposure to the US, so they are doubling up on that exposure. We're really thinking through that and trying to make sure that we're not just doubling up on the same thematic that everyone in the world is chasing at the moment. So just to wind up, if I touch on our portfolio holdings, the thing that makes me pleased at the moment is that we've got a really economically diversified portfolio. So you look across those top 10 overweights, there's a lot of different businesses with different economic exposures there that aren't just giving you that strong thematic exposure to things like banks. Obviously, on the other side of the equation, the things that have done really well, particularly very large stocks like banks, materially underweight both the sector and a lot of the major stocks in things like banks, in CBA and Macquarie, and a lot of those highly priced market darlings like the Goodman Groups, the Aristocrats, etc. So we are very comfortable that the portfolio is well positioned for what we think at some stage has to be a real changing of the guard. The amount of the world's money that is piling into the US is just, to us, unhealthy. I know it reflects the fact that no one can find good news in China or Europe or the rest of the world, but valuations matter. They are always a huge driver of future returns, and I think people need to be careful not to shed your valuation discipline at the worst possible time.